Shopify just reported their latest quarterly earnings, a double beat, and issued guidance as well, but the stock is down 10% at the time of making this video. Of course, a lot might change, probably will change when the market will open. There's also the CPI report, so that can have a major impact on how stocks trade during the day. But Shopify being valued at a high premium right now is probably one of the main reasons why the stock is down despite a double beat. We're going to have a look at the report and I'll add a bit more context as well. But first up, let's start with a couple of comments here from Harley Finkelstein, the president of Shopify, and then the CFO Jeff Hoffmeister. So as we look ahead to 2024, our focus remains on driving innovation in an ever-evolving commerce landscape, delivering products that will propel our merchants' business forward with the support of our world-class talent and our valued merchants and partners. Our GMV growth accelerated in Q4 and for all of 2023, which powered Shopify's strong financial results. In Q4, we delivered year-over-year revenue growth of 24%, which represents 30% growth when adjusted for the sale of their logistics business, and achieved an operating income margin of 13% and a free cash flow margin of 21%. For 2024, we look to build on the momentum that we achieved in 2023 and continue to deliver a strong combination of both top-line growth and profitability. And so, let's dig in a little bit further. GMV, or gross merchandise volume, increased 23% to $75.1 billion, an increase of $14.2 billion year over year. As they said, revenue increased 24%, which translates to a growth of more like 30% after adjusting for the sales of the logistics business. Then as for the merchant solution revenue and subscription solutions revenue, merchant solutions increased 21% to $1.6 billion, and subscription solutions increased 31% to $525 million year over year, driven by the growth in the number of merchants and the pricing increases in their standard subscription plans. Now, more recently, there was a report that said that Shopify is allegedly going to hike the Plus plan to $2,500. That's an increase of 25%. Of course, we know that the last time they did a price raise, the churn was very, very minimal. So this should be viewed as highly positive since it will make their bottom line grow faster than before. Now, before continuing, if you enjoy this type of videos, leave it a thumbs up, subscribe if you have not, would really appreciate that. If you want to support me even further, do check out the link down in the description and in the pinned comment to get the top 10 best stocks to buy now, or go to fool.com/couchinvestor. Thank you very much. Now, going back here to the highlights, GPV, gross payment volume, that grew to $45.1 billion, representing 60% of GMV processed in the quarter versus $34.2 billion or 56% in the same quarter last year. As for MRR, or monthly recurring revenue, that increased 35% to $149 million. Now, I always show the difference here between subscription solutions and merchant solutions with regards to revenue and cost of revenue. Always like to see if the revenue increases faster than cost of revenue, which of course will have a positive impact on gross profit. We can also see here that operating expenses decreased year over year. Which segment decreased the most? Well, R&D decreased and G&A basically cut in half. And then last one here for this quarter was the free cash flow. This is becoming more of a free cash flow story than anything else, in my opinion. So free cash flow was $446 million compared to free cash flow of just $90 million same quarter last year, with a margin of 21%. As for the whole of fiscal year 2023, GMV increased 20%, revenue increased 26%, GPV was $137 billion, which was 58% of GMV. Gross profit dollars grew 28% year over year, and gross margin was 49.80%. As for free cash flow for the whole year, that was just under $1 billion, so $905 million, and free cash flow margin was 13%. Then they do give us some guidance for next quarter, so they expect revenue to grow at low 20s% rate on a year-over-year basis, which translates into a year-over-year growth rate in the mid to high 20s when adjusting for the 500-600 basis points impact from the sale of the logistics business. Gross margin for Q1 is expected to increase approximately 150 basis points quarter over quarter. Stock-based compensation will be approximately $105 million. And then with regards to free cash flow as a percentage of revenue, that should be in the high single digits with sequential improvement every quarter throughout the year. Again, free cash flow, in my opinion, I've said this already 2-3 quarters ago, free cash flow is the metric to look at. Now, all that said, great quarter, great company, great management, right? I mean, if we look at the stock's performance over the last year, stock is up 84%. So, of course, very, very high expectations. Market cap of $114 billion. Of course, right now, a bit less with the pre-market action, but you're not buying here a very, very cheap company. You're buying a company that will grow quite fast, is expected to grow quite fast as well. But right now, 85.8 times forward PE. And if we look at the analyst expectations for fiscal year 24 and 25, sales growth of approximately 20% for both fiscal years, then EPS to grow 54.34% in fiscal year 2024, then another 27.75% in fiscal year 2025. So again, nice growth top and bottom line, especially bottom line, but still, if you look at fiscal year 2025, you're still paying, close to 60 times PE? Not the cheapest out there. Again, we've been saying this for quite a while. Usually special companies, great companies with great management trade at a premium almost all of the time, which, as you can see right here, comparing the valuation right now to its 5-year mean, I mean, it is much cheaper than before, but that's just because before was just extremely, extremely expensive and not that profitable. And so last thing here is the graph. This is on the weekly. As you can see, on Monday, we were already overbought. So we started the week with a red candle. Right now with the pre-market action, we are trading just below the 20-day moving average at around $81.53. The 50-day moving average sits at around $78. And the 200-day moving average would be a very, very nice opportunity to add, in my opinion, sits at $65 or so. Again, a lot can change when the CPI report comes out. What happens with the market? If it's a positive sentiment, it means that rate cuts will be happening sooner than later. Usually the stock market and growth companies go up. If that's not the case, then maybe Shopify will take a bigger hit because it is already such a highly valued. It is a highly valued company that is trading at a high multiple. So there you have it. Those are the reasons why Shopify is down after reporting a double beat, quite a strong quarter as well. Do share your thoughts and opinions down in the comments below. If you enjoy this type of videos, leave it a thumbs up, subscribe if you have not, and I'll see you all in the next one. Bye bye.